As the new week begins, crypto markets remain under the shadow of last week's trade-related sell-off. Bitcoin fell sharply on Friday, reaching just above $104,000, while Ethereum slipped nearly 6%. Since then, prices have stabilized but have not yet shown convincing recovery. Weekend trading volume was light, and most participants appear to be waiting for new macro signals before taking fresh positions. The key question now is whether this correction evolves into consolidation or extends into deeper retracement. Several forces will decide the direction over the next few days. First, support zones. For Bitcoin, the area between $95,000 and $105,000 represents both psychological and structural support. This range coincides with the base of the last major accumulation zone from early September. As long as that floor holds, analysts view the larger trend as intact. A sustained break below, however, could invite further downside toward the 90,000 region. Ethereum shows a similar structure, with support near 4,000 and resistance approaching 5,000. Its ability to defend this range will likely influence the broader altcoin market. Second, derivative flows. Roughly $5 billion in Bitcoin and Ethereum options are expiring this week. Such events often create short-term volatility as traders adjust hedges and unwind leveraged positions. If volatility contracts after expiry, it would suggest the worst of the mechanical selling has passed. Third, institutional participation. ETF inflows remain the quiet foundation of confidence. Throughout the recent decline, no significant outflows were recorded from major crypto funds. If this steady demand continues, it could act as a stabilizer once short-term traders finish repositioning. Fourth, the macro environment. The US dollar strengthened after new trade measures targeting Chinese exports heightened global uncertainty. A firm dollar typically limits risk appetite, including for digital assets. Should trade rhetoric soften or central bank guidance turn more accommodative, capital could rotate back into crypto relatively quickly. From a technical perspective, several indicators have cooled. The relative strength index has returned from overbought territory to a neutral reading, suggesting the market has reset rather than reversed. Funding rates across exchanges have normalized, showing less speculative leverage. These signals point toward balance forming beneath the surface. Market behavior over the next few sessions will reveal whether that balance can hold. A steady climb in volume without renewed selling would indicate accumulation is underway. Conversely, another surge in liquidations would confirm that traders are still de-risking. For long-term participants, this environment favors observation over reaction. Sharp corrections can be uncomfortable, but they also clear excess leverage and create healthier market structures. The same pattern has repeated throughout every major crypto cycle. The broader picture remains constructive. Adoption continues, infrastructure improves, and institutional interest grows. Short-term volatility is part of that maturation process. In summary, the week ahead is about stability, not speed. If support holds and ETF inflows persist, crypto may transition from shock to consolidation. If macro pressures intensify, another leg down is possible before buyers return. Either outcome contributes to the same long-term rhythm: expansion, contraction, recovery. Markets evolve through adjustment, not perfection. Understanding that rhythm allows investors to interpret movement without emotion. The next few days will show whether confidence begins to rebuild or caution remains the dominant tone. For more insights on Bitcoin, Ethereum, and the forces moving the crypto markets, remember to like, subscribe,